Last time we had you on the show, April 18th, Chevron had just made an offer to buy Anadarko. 12 days later, Warren Buffett and Berkshire Hathaway jumped into the mix. We're going to talk about that today. But then this morning, Chevron announced they're pulling out of the deal. So, every time we come on this show, we're getting new news, new stuff to talk about here with this deal. So, just the news of the day before we kind of dive in deep into kind of the details of this deal. What's kind of your thoughts on Chevron pulling out today, taking that $1 billion, breakup fee and kind of taking their ball and going home?
Yeah, I think that makes total sense for them. Even though the deal really looked good from a Chevron perspective, there's so much more strategic benefits to them than I think for Occidental. But, taking $1 billion is, I think anyone would take that, especially in the oil industry. Oil prices have been so volatile. This deal could really hamper Occidental in the long term. I did like something that Chevron CEO said. He said, winning in any environment doesn't mean winning at any cost. And so their ability to, look at the cost and say, this isn't worth overpaying for that, I think that makes a lot of sense for them.
Yeah, and $1 billion doesn't hurt either. So, just to kind of break down how things shook out, Chevron had offered a deal at $62 a share. But then Occidental came over the top and offered $76 a share with $59 of that in cash. Earlier this week, we got Anadarko's board kind of said that the Occidental bid was bigger, and then Chevron pulling out today. So as we sit today, this is where we're at. And, what really made this deal possible were a few moves that Occidental was able to make to kind of generate some cash. So kind of there are two deals there. We have the Berkshire deal, which we'll talk about. But first, let's talk about Total. They're going to divest $8.8 billion worth of assets in North Africa. And that's Occidental had said they were going to divest $10 billion in assets to be able to make this Anadarko bid work. This gives them $8.8 billion of that. What should we kind of know about this deal? What does it mean for Total to kind of take that position in North Africa and take these assets away from Anadarko?
Yeah, so it makes sense for Occidental to pawn these off on Total. They're not really big in international markets, especially in Africa. So it makes a lot of sense. The question I have is, there was really no bidding on this that we know of. It was kind of like, hey, could you take these off our hands? And $8.8 billion is a lot of money for this. It does take off the LNG project that Anadarko was working on in Mozambique. That could be a big deal for Total over the long run because LNG is just this huge, fast-growing market. China is consuming a lot of natural gas, so they need LNG. So, it makes a lot of sense for Total to pick that up. They want to be a bigger player in LNG and kind of rival Royal Dutch Shell. So I think it's a good deal on their side. I don't really think Occidental got full value for it, but that's, my opinion.
Yeah, it seems to be the case. It seemed that Occidental felt a little thirsty on this deal. They're making a lot of moves to kind of generate the cash to be able to make it happen. Going to the Berkshire side of this deal, Berkshire got really an incredible deal from Occidental as well. So Buffett committed $10 billion to a preferred stock investment in Occidental Petroleum with an 8% coupon. So that means Berkshire's going to be getting $800 million annually every year from this deal, which for an investment grade company is the high end of normal. So really favorable deal for Berkshire, as well as, he got a sweetener in the form of, warrants to purchase up to 80 million shares at $62.50 a share. So when you look at this deal, it's kind of same question. It appears very favorable for Berkshire. What does this mean for Occidental? What was the rationale behind this deal?
Yeah, so there's two main concerns from investors on this deal. One of them was all the shares that they were going to issue to Anadarko, and that would have, if they issued more than 20%, they would have had a shareholder vote, and they were concerned that shareholders would vote the deal down, and there's been a lot of talk that now shareholders will vote out the board. So in order to get around that, they needed to offer more cash, and so that's where the asset sale in Africa, and then this thing from Buffett, because there was concerns about the balance sheet. Now, Occidental has a great balance sheet, A-rated credit. However, they're taking on a lot of debt in this deal. They're assuming Anadarko's debt, and then they're paying all this cash. And so one of the ways to kind of get around that is to use preferred stock, which it's like common shares plus equity. So it's kind of got that 50-50 balance. So it doesn't like weigh down the balance sheet in the eyes of like credit rating agencies. So as a way to kind of get around that. But the price they're paying is really incredible. Some analysts thought they could have got 6% if they did this deal through the public markets. And then, there's no, it's perpetual. So Warren Buffett could conceivably get this, $800 million a year forever. And he got $50 million just for signing the contract, whether the deal went through or not. And then you throw in the dilution from the shares that he can get. That's how he made all that money back in the financial crisis. He invested in like Bank of America and just banked big bucks from that, those warrants. So I think he's coming out well ahead on this deal.
Yeah. Again, you look back at the financial crisis, you had folks who needed money quick, it's just in, uncertain times. And here it seemed that Occidental really wanted to get access to this cash quick so they could get over the top of Chevron's bid. And then somebody like Warren Buffett and Berkshire are one of the few people out there that have the capability. I mean, I think when you listen to Buffett talking over the weekend about the deal, the details of it, I want to say, he first heard wind of it on Friday and the deal was, closed on paper by Sunday. There's not a lot of folks out there that could have made that deal happen that quickly. And, the ability to do that allows Berkshire to extract some pretty favorable terms. And, this is a classic deal for Warren Buffett. I mean, it seems like there's not a lot of downside for them from this deal. Again, Occidental looked a little thirsty. You mentioned some investors, T. Rowe Price in particular, said, hey, if this doesn't go to a vote, we're probably going to vote against your board of directors here. So, I can see it making a whole ton of sense. It does obviously make a whole ton of sense for Total and Berkshire here. We'll see how things play out for Occidental. Some question marks about how much they paid. With this payment going forward in perpetuity, do you think this is going to restrict the flexibility of the business moving forward? Or how does this play out on now that, this merger happens? What is this liability going to do to the company's ability to invest further, into the future?
Yeah, it does a lot of things for the company. They've already said that they're going to slow down their growth rate. They're supposed to grow maybe at an 8 to 10% rate going forward. Now they're going to slow that down to 5. Now that's off a larger base. So there's a little bit of that, but they want to generate more free cash flow so that they can pay, Buffett and then pay down debt and things like that. But the structure of this preferred really hampers them. The way it works out is if they pay out more than $4 a share to their investors, which it would be like the dividend plus buybacks, and the current dividend is $3.12 a share, they have to redeem these preferreds at 110%. So like $10 billion plus another billion. So it hampers their ability to buy back stock. It hampers the ability to raise the dividend. So, and then, if oil prices crash, now Occidental, they can do very well at $40 a barrel. But, if oil prices did, sustain a long downturn, they could have to cut the dividend or things like that because they're paying so much for this. And so I really question this deal. I hope I'm wrong for their perspective. I know why they're doing it. The Permian Basin is just this phenomenal basin. They're picking up a lot more land. They should be able to get a lot more drilling, but it just seems like they were way aggressive.
Yeah, it feels a little thirsty, like I said before. We'll see. We'll see how things play out. The Permian has the chance to really drive a lot of upside, but time will tell.